Okay, and it's the crack of 11:10 or maybe 7:10 where you are, Vitali. So welcome everyone to today's CDAR seminar. I am delighted to introduce my old friend, Vitali Kalesnik, who is coming to us from London. He's at Research Affiliates and will talk to us about rebalancing indexes. So Vitali, please take it away.
Thank you very much. Well, so this work first is a joint work with Robert Knott, Chris Brightman, and Lillian Wu, and we are in the process of actually update. The article has been written some time ago. We're in the process of updating it as we speak. So in a few weeks, I'll be able to share the most current version. So what is this research about? Well, the indexing is a big part of the investment world. So investors are investing trillions of dollars in index funds, and there are strong convictions and strong reasons for why indexation makes sense. Now, at the same time, some of these ideas are not exactly right. They're not corroborated by the data, and there are ways to improve on the existing status quo of indexation. So with this, let me start by saying that well. First index funds appeared in 1973, and it was a response to the mounting evidence that majority of active funds underperform after fees. When first index funds showed up, they considered to be un-American and something really crazy to do, but at the same time, there were in the early 70s showed the first institutional and later retail products showed up. That the indexation was strongly supported by much of the appearing and becoming more and more popular academic research around finance, specifically the efficient market hypothesis and the CAPM. Where efficient market hypothesis is saying that given that markets are very competitive, it should be really hard to earn a kind of on a return in excess of the non-diversifiable risk. And CAPM, basically the capitalized pricing model, said that cap-weighted market is pretty much the embodiment of this systematic risk. And that's why the investors should be investing in the passive market portfolios. As indexing gained assets and investors start looking at the performance of index funds and comparing the active managers to the passive funds, investors very quickly discovered that, well, actually, there is a pretty strong evidence that with the passive indexation, they are ahead after fees by a pretty big margin too. So that's one thing, and then showed up an important narrative that basically, if you want to invest in active management, in an active fund, and pay high fees, then you should be compensated for it with a higher after-fee return. And that's where managers start more and more attract to passive funds, to indices. And at the same time, on the other hand, that created a reaction on the asset managers side, where they started hugging the benchmarks and managing to the index performance. In the most extreme side, there were closet indexers where they were delivering close to index-like portfolios at higher fees. Now, As the popularity of indexation grew up and as the amounts of assets grew, so did indices started evolving to accommodate these flows. So, for example, when S&P 500 was first started, it was viewed as a benchmark. It wasn't supposed to be necessarily a investable product where by now trillions of dollars are tracking it. Instead, they were viewed as market proxy. And as market proxy, you shouldn't worry about issues like such mundane things as capacity, as accommodating potentially large trading amounts, etc. And when index funds were compared to the index performance, they very quickly the index fund managers very quickly realized that they have hard time tracking the index because, for example, before the 80s, before 89, the S&P 500 committee would decide on the change to the index. It would be announced on the day of the change, and then the index funds were supposed to rebalance to these changes after the fact, after the index composition was already changed. And you can imagine that that should be fine if you're tracking a really tiny portfolio. But if there are, well, at the time, billions of dollars tracking the index, then with these billions of dollars running for the same liquidity, you either underperform the index, buying the stocks and selling some stocks that leave the index and buying the other ones that are added to the index at unfavorable prices after the liquidity shock, or you have to live with some tracking error. And so to accommodate this change, the index funds managers decided to pre-announce the changes to the index. And that created a problem because now as the trillions of dollars are trading to these changes, to additions and deletions, they are still moving the prices. Just these prices are reflected in the index changes themselves. And to a degree, that's making the index fund life better because they're tracking the index to the ladder, but at the same time, these price impacts are embedded in the index performance. And that's so that hidden trading cost is just one example of ineffectiveness in index construction. Also, index funds, indices, like let's say S&P 500, they try to track companies, 500 largest companies by market cap. Now, there are some differences, and they have a committee decided on what exactly companies to include and not. But doing this and selecting companies based on capitalization and weighting based on capitalization results in this outcome where if you allow for some mispricing, the resulting index would be selecting companies at the rebalancing which are a little bit more expensive and selling companies that have recently dropped in price and are cheap. And as prices mean revert, this rebalancing results in a return drag. And so bottom line, that's a very long introduction, but the bottom line is we'll talk about two Achilles heels of indexing coming from this, from using capitalization to weight and rebalance stocks that could be avoided and that could lead to an improvement to an index performance. So with this
question,
yeah.
So I agree that there's an issue here when the index changes and stocks are added or dropped in the index, but with a cap-weighted index, the prices of the stocks adjust upward or downward on a given day, there's no rebalancing that results from that, because you're holding matches the weighting in the index before the change has happened, and it matches it afterwards. So an equally weighted index, you have to do rebalancing, but cap weighted index, aside from changes in the composition of the index, there's no rebalancing.
So that's absolutely true. Having said that, so that's true for let's say buy and hold portfolio investor. If investor were to buy and then hold for a very long time. Now, at the rebalancing, and you already mentioned that happens at the rebalancing. But in terms of weighting, very few actually buy and hold over very long time. More realistically, you have investors either on the contributing part or on the draining down part of their investments. And so, for example, if you are an investor in a cap weighted index, you can, so let's say, take tech bubble as an example. And when Cisco, for example, was trading at a PE of 80 in 1999, you would be allocated 2% in the S&P 500 portfolio weight. When Cisco went to PE of 180 in 2000, a year later, if you are contributing to your 401k and buying the index fund, you'll be already contributing to a 4% allocation to Cisco. And next year, when Cisco price dropped significantly, and PE, I think, if I remember correctly, PE I think went either to 40 or to 20. So the weight kind of normalized to some more reasonable, some average multiples. But on the amounts that you were contributing at that period, you did experience a return drag. So that would be one example. Now, having said that, with equal weighting, so with any other deviation from cap weighting could potentially, so some deviations would require trading a little bit more, some may not, and we'll talk about them in a little bit more detail.
Vitali, can I ask a question following up on Bob's comment? Yeah. Two words. One is dividends and one is free float, both of which are kind of frictions that take us away from the market cap thing being perfect. Do they make a substantial contribution in the sense of your Achilles heels?
So free float and dividends they do not. So they do. They kind of contribute to that idea that the idea that there is a prevalent idea that basically cap weighting is occurring. It has no turnover, and you're not trading anything, and that's just not true. Even with funds with indices like S&P 500, and I will show the evidence later, we experience more than 4% one-way turnover per annum. And the turnover is coming from dividends. Part of it is dividend reinvestments that you mentioned, but also the stocks coming in and out. And that kind of costly distribution, that turnover, when there are trillions of dollars doing the same trades, can be costly and could be optimized around to improve the returns. And for free floats, the problem becomes even more severe as we're looking outside of the United States, especially in the emerging markets with the state-owned enterprises, in particular, where the market cap becomes very, very different from the what is available investors. So that's again another can of worms, and so largely in this analysis we ignore that. So with this, let me start and talk a little bit about how indexation became quite popular. I mentioned already the theoretical background, and there is the arithmetic of active management, which I mentioned earlier as well in brief, saying that that after fees, the index funds are market portfolio, and if you take any allocation from it, the result is still kind of the combination of that plus the rest of the market is the market portfolio. And so as a result of this, so index funds and active managers in collection should have the same gross performance before fees and significantly greater performance for index funds after fees. So what's the empirical evidence on that? So here's a very simple table which looks at gross of fee performance for passive and active funds and before and after fees. And you can see that so when we are looking at the excess return on top of the market portfolio, we have close to zero for passive funds gross of fees, and very similar, kind of slightly negative at negative 0.3, 30 basis points for active managers. Now, when we're looking at net of fee returns, we see that that active managers lose on average by a pretty large margin. So the average for the Morningstar universe is 160 basis points per annum, compared to about 40 basis points for passive. Now, so passive are not exactly zero fee portfolios either, but when we're looking at the difference of 120 basis points, it easily puts the average index fund in the top quintile of the net of fee active managers. And so net of fee performance for investors is very much in favor of the passive funds. And so as a result, what we've seen continuously is the big proliferation of passive investing that started in the 70s, but gained most momentum in the last 30 years. And you can see that, so here we're looking just at mutual funds and ETFs from the Morningstar. And you can see it started from about 3%, actually it's about less than 5% in 1990, and it went to 40% in the end of 21. Also, interestingly, that's just only the mutual funds. That excludes a lot of the proprietary institutional investors, which are even more favoring passive implementation. So when that is added, probably the amounts tracked by the passive investors is probably closer to 60% in the States. And so I mentioned to you that this is a very strong evidence in terms of performance, and the common beliefs about passive funds is that cap-weighted indices have high liquidity and capacity. They essentially reflect all of the market available to the investors, so that they give you the market representation. They have close to none turnover and trading costs. They have transparent positions. They have low fees, and a track record of beating active managers. So not surprising that we've seen such big proliferation. But as we'll see, some of these are probably interesting beliefs, but we need quite a bit of nuance to understand them better, especially in terms of liquidity. What are we actually looking in terms of the market participation and the amount of turnover and trading costs that we're actually incurring by trading these strategies. So
Can I interrupt you again before you go on?
Yeah.
I'm like amazed by those 40, 60% numbers. And I'm thinking back a few years, your un-American comment reminded me of a paper that I think Allianz Bernstein put out with this incredibly catchy title, "Is Passive Investing Worse Than Communism?" And they got, I can send it over if you haven't seen it, that they were arguing that passive investors are doing harm to the economy by making no information decisions and taking the what do they say, the market is a weighing machine, taking the smarts out of it. And I don't know if you're going to go in that direction, but the question came up, and I've never seen a good discussion of it. Maybe there is one, of how much the market needs to be passive before it just collapses and it's just all noise. Like where is there some equilibrium model in there or something? And it seems like going pretty high.
Yeah, I definitely saw the paper, and it's about the kind of building on Grossman, probably, and Stiglitz type of model where you need informed traders to drive the equilibrium, and that much of the passive investors are price takers in that perspective, and they're contributing very little to that equilibrium discovery. Now, having said that, I think a lot of the I view this so I was not planning to go in that direction, but I can comment that well, in my opinion, so we can have 100% obviously passive, because then there will be we'll start at some point we'll start having very strong arbitrage opportunities that will be easily explored, and supply brings kind of demand brings supply. Basically, if there is an opportunity, somebody will come and exploit it. I also think that when we compare a lot of the information acquisition today versus what it used to be in the 60s and 50s, for example, while computers have become a lot more efficient and mechanized, so with more liquidity, I think smaller fraction of players can drive that information efficiency. Now, having said that, I do think that there are some signs of so probably where it there are two things that are probably convenient also to disentangle. One is the outcome, the equilibrium outcome, and second is the movement to that equilibrium. And so as we're moving to that equilibrium, I think a lot of the things that we see are big investments into companies. So cap weighting naturally favors the companies that have large valuations. And today, as we're seeing these huge flows, a lot of these huge flows are going essentially towards the companies that are more attractively priced. If these flows were to stop or slow down, could we see some corrections among the larger companies? Potentially, yes. But I will come back to that comment about the large companies in a minute. But let me come back to these points about broad market representation, liquidity, and turnover and trading costs. So what about the market representation? Well, if we're looking at S&P 500, for example, the blue line here shows the what top 500 companies represent as a fraction of the US equity market. And that's definitely not a full market. When we're looking at them as a fraction of the global equity market, that's even less, that's significantly less than 50%. And so what it means is when investors are prone to taking shortcuts, and when they're investing in the market and thinking that with S&P 500 they're getting the market, they don't. Now, obviously, that's a minor quibble. Now, let's go to more substantial quibbles or concerns around the passive indices. So the driving force for cap weighted index was the idea that markets are efficient and it's really hard to beat the market to find excess returns. Now, starting from the 80s, we started gathering evidence that actually markets are predictable to a degree. And let me just quote, now, by now, there are 400 or so factors published in tier one academic journals alone, but probably majority of them are data mined. But having said that, there are pretty strong, some pretty strong regularities in market performance, and value, size, and mean reversion related anomalies are pretty strong and pervasive over time periods and different markets. So here, for example, I'm showing the portfolio return differences between the two types of portfolios, and this is DeBond and Thaler in 1985, results showing the mean reversion in the stock performance, where we are looking at the winner and loser portfolio, and loser stocks are the stocks that did the worst in the last 3 years, and winner stocks are the ones that have been doing the best in the last 3 years. Subsequently, what we see is the reversal of fortunes, where in the next subsequent 3 years, the difference in return is 24.6% return. Now, yeah.
Vitali, sorry, do you know what universe they used? I should know that paper. I probably read it. Do you know?
So their sample is 33 through 80, and I think they're just using the CRISP universe.
Okay, so there could be also a lot of illiquidity effects in their data.
Correct.
Okay.
Having said that, even when so the value and mean reversion effect is pretty pervasive outside of microcaps. So yes, there is a fun article where people took like 300 plus articles, 300 plus anomalies, and removed the worst 2% of the microcap stocks, and I think they've after that 90% of those didn't replicate anymore. Now, having said that, the mean reversion is robust to excluding the microcaps. And by the way, so we extended the period to 2014, and still we have, in the long run, very similar to the same type of return. And so with this, so that brings us back to the idea that cap-weighted indices buy companies, they tend to buy recent winners and tend to sell recent losers. That is kind of the core of this study, but they also overweight the larger companies and underweight the smaller companies. Now, if you are in the long run holding game, as we were just discussing before, that shouldn't make a difference. But if you are continuously contributing or drawing out from it and caught in the middle, that can create troubles. And again, to put it, give you a few kind of salient points, let's look at the top 10 names historically as they were changing in the market. So, for example, in 1980s, a lot of the top names in the global market were energy, because, well, just recently at that time, the Iranian revolution and OPEC was at its height, and oil prices were just great. Now, a decade later, actually, out of that out of that list of stocks, only one name survived, and that was IBM. All the top names in the global, actually two names, sorry, IBM and Exxon. next decade, in 1990, though, the index was completely dominated by the Japanese banks. It's quite fun to sometimes rewatch things like Die Hard, but if you were to turn on Die Hard, you'd hear about like this theme in the background where the Japanese were going to overtake all the world, and I think the market was pricing some of that in. Now, interestingly, a decade later, not many of these names are still there. So Nippon is there, but and Axon, but now it's looking very very different. A decade now, of course, 2000 was the height of the tech bubble, and very briefly, very soon after that, many of these companies were out of the top 10 names. And then a decade later, again, it was 2010. That was the period when oil prices were again in favor, and emerging markets were priced quite richly, because the world was looking at BRICS and thinking that market was going to be overtaken by BRICS. Now, a decade later, in 21, the market is largely dominated by tech companies. So basically, market cap has placed this game of putting larger allocation to larger companies. And again, as if you are kind of very patient, you will stay through it. Now, at the same time, that's probably also an opportunity. If you want to be a liquidity provider with a very simple strategy like equal weighting, or for example, what we show here is, so S&P 500 was cap weighted. A little bit earlier in the 50s, Fortune 500 started the name, where they were collecting the companies, assembling companies by sales. So suppose we were to take the Fortune 500 name list and weight these companies by sales. Well, if we were to do the same exercise and rebalance into this portfolio annually, this strategy would have about doubled in the period 73 to 2017 versus the investments in S&P 500. So now that's just a very quick quibble along the fact that the raw beatable or the raw available opportunities in the weighting scheme, but that's not the core of this research. So I'll now, at this point, I will not talk more about weighting, and will mostly talk about the rebalancing and these bottom names that are dropping in and out of the index, and discuss what type of return are we missing in terms of the transaction cost, and in terms of the avoidable buy high and sell low dynamic. So, and before that, as we're going into that, it's good to understand just the amount of assets that are tracked by indices, tracking strategies like indices like S&P 500. So S&P 500, so there are trillions of dollars tracking these indices, and today the largest mutual funds and ETF are trading cap-weighted portfolios, many of which, like 3 out of 5 largest ones, are actually pretty much S&P 500 or a close knockoff, where Vanguard 500 probably just doesn't want to pay fees to S&P and just selects the 500 names themselves. But S&P.
Can I ask a question? Yeah. Isn't Vanguard TSM? Doesn't that stand for total stock market? So it's something like a Wilshire 5000.
Yeah, so TSM is. So what I meant is 3 out of 5. So Vanguard 500, okay. Spider 500, and iShares. Yes. So the other, but all 5 of them are cap weighted, and so yes, you're absolutely right. This TSM is the is the broader. So it's pretty much representing all of the universe. Now,
so the reason I asked that is that that would seem to avoid the issues about stocks coming into the index and leaving the index. So there are lots of companies that are somewhere near the frontier of the 500 largest and go in and out of the S&P 500 index. There are, of course, new stocks that are going to come into the TSM index, but they're relatively low in value when that happens. So the TSM index, it would seem, should do better in terms of the issues about changing the composition of the index.
So you're absolutely right. It would incur lower turnover, but it will incur turnover at the lower spectrum of the market capitalization. And as we are going into that lower market cap and lower liquidity segment, the per stock difference and per stock liquidity supply and demand issues become even worse. So you're absolutely right. On absolute, that issue becomes more muted, but on the per stock level, it's still there.
Yep. Thank you.
But coming back to S&P 500, 3 out of 5 are tracking essentially S&P 500 or close to it, and S&P 500 is not exactly the no turnover strategy. It has the average turnover, one-way turnover of 4.4%, and multiplied by 4.2 trillion tracking S&P 500 directly, and we get roughly 185 billion worth of stocks sold and bought every year. Now, that's 4.2 trillion is, by the way, only the tracking directly, the assets tracking directly. There's probably double, if not more so, amounts that are kind of closer to index or benchmark to S&P 500. And even though they're not exactly tracking it, to avoid the tracking error, they're also fighting for some of the same liquidity. So probably we should multiply that number by 1.5 or maybe even 2. But when we see this amount of trades, that moves the prices. So I already talked about the issue around the rebalancing. So basically, before 89 S&P 500, they were the way it would be rebalanced would be on the day of the rebalancing. The committee would announcement after the index were changed, and then the implementers would be able to trade only the index after the index composition was changed. Since October 89, S&P began pre-announcing index changes, and what it resulted in is that pretty much the transaction costs disappeared. Trading costs seem to have disappeared. The problem was that investors started trading on the day before the rebalancing was taking place, and moving the prices. And so now the prices embedded in the index transaction were already incorporating some of the transaction costs, and this effectively hiding the transaction costs in the index performance itself. So to give you as an example, last year Tesla was added. Anyways, let me just explain this chart. So what this chart is showing is it shows the rebalancing, the spike in the liquidity, the spike in the volume traded for Tesla on December 21st of 2020. So last year, Tesla was added into S&P 500. And when it was added, it was the largest addition to the index. Now, interestingly, S&P 500 is supposed to be tracking the 500 largest companies, but S&P committee has other criteria for including the companies. So, for example, Tesla was for a long time in the top 500 companies by market cap, but it wasn't included because Tesla had negative profitability. And S&P requires 2 consecutive quarters of positive earnings before a company is included in S&P 500. Now, for Tesla, what that meant was that Tesla was already the 6th largest holding in the market, the 6th largest company by the market capitalization, and it was the largest company by percentage or by total market cap to have ever entered the S&P 500. And Tesla was entering in one go on one day on December 21st, 2020. So blue bars here are the percentage of shares outstanding. So are showing the volume traded as a percentage of shares outstanding, and you can, and that's on the left-hand side. And you can see that if on average Tesla was trading at sub 5% on the day of the inclusion, it was trading close to 23%, which is a significant spike versus its normal volume traded. Basically, on the day of the rebalancing, investors were buying Tesla to put into their index funds, and as that happened, the price of Tesla went up. You can check that indeed that happened, and it was registered in S&P 500 at a higher price. So of course, Tesla is just an illustration of what was happening. Generally, so here's the list of, here's the table which shows the number of discretionary additions, non-discretionary additions, and discretionary and non-discretionary deletions. Now, we will focus here only on the discretionary additions and not discretionary deletions, because, discretionary additions and discretionary deletions, because these are the type of companies that are most prone to this buy high, sell low dynamic that I was mentioning before. So total, let's say from 89 to 21, there were 663 companies which were discretionary additions, and there were about 300 companies which were discretionary deletions. And how does the company qualify to be added or sold? Well, I told, as I said already, based on the stock performance. So here in this table, we're tracking the performance of discretionary additions and discretionary deletions a year before the rebalancing of the S&P 500 portfolio. And you can see that a year before, the additions tend to outperform the market by about 42%. So not surprising, they tend to grow, and then they tend to be selected in the portfolio. While discretions tend to fall by about 29%, so that they tend to fall significantly in price. So the difference in one year prior to the index change return tends to be about 71%. Also, what we see is that this buy high and sell low dynamic results in a significant discount that we see for additions versus deletions. So, for example, when we compare here at the bottom part of the table, we're seeing 3.5 to 6.5 higher multiples, depending on whether we're looking price to book, price to earnings. But regardless, additions tend to be slightly more expensive than the market in terms of price to book and other valuations. And discretionary deletions tend to be cheaper than the market. What about the subsequent performance? Well, after after the announcement and leading to the rebalancing date, the additions and deletion performance goes in the same direction as before. And again, that shouldn't be surprising because we have a big pool of money either accumulating the inventory to supply later to the index funds of the day of the rebalancing, or chasing that stock on the actual rebalancing date, and vice versa. Well, for the deletions. So not surprising that then between the announcement and the actual rebalancing being effective, the difference in performance between additions and deletions is about 12%. Now, interestingly, subsequently, this performance reverses, and additions tend to underperform, not by much, only by 2.3% return. They've experienced, now, if we were to believe the rest of the market anomaly literature, they actually are supposed to continue growing because they're strong momentum companies, but they don't. They tend to fall down a little bit. Now, at the same time, discretion deletions actually recover quite significantly. So the return difference between deletions and additions a year after the rebalancing is about 23%. Let's say with Tesla, for example, if we were to take Tesla as the most salient example, last year Tesla was included into the S&P 500. Actually, Tesla, unlike much of the historical additions, continuing growing, and actually for some time over the last year, it actually outperformed. But interestingly, when we compare Tesla, regardless of its phenomenal return, even after additions to S&P, after the addition to S&P, if we were to compare it to the AIV company, which it replaced, AIV company earned, I believe, like 80% return a year after the rebalancing. And it still beat Tesla with its performance. So bottom line is, and that chart basically illustrates what I was saying, discretion deletions prior to rebalancing, prior to the announcement, additions outperform, deletions underperform. It continues to the rebalancing point, and subsequently in the year afterwards, the fortunes reverse, and the gap is about 22%. Well, that's a measurable fact, and it can be avoided. So here is, for example, a very simple strategy that can avoid it. So why don't we use fundamentals? So I mentioned before weighting by sales and selecting by sales. Well, here's another way of doing it. Why don't we select companies based on sales, cash flows, dividends plus buybacks, and book value, kind of the fundamentals measures of size of the company, and we don't just focus on one measure, which is sales. We just do it a little bit diverse, and select 86%, which roughly correspond to the largest 500 names in the United States, and then cap weighted them. So don't do the sales weighting, which again, as we've seen before, likely would drive higher return and higher turnover. Suppose we're not interested in any other weighting scheme. Suppose we were just still interested in cap weighting. Well, this type of strategy, we call it truckweigh. But suppose it's so when you're looking at this portfolio, it will, on the top, it will be exactly the same or largely the same. The order will be exactly the same, but weight might be a little bit different from the market portfolio. But the bottom names will somewhat disagree. So, for example, it would have some more growthy companies at the bottom in the cap-weighted portfolio, and more value companies at the bottom for this cap-weighted, fundamentally selected cap-weighted portfolio. Now, what about the return difference? Well, if we're looking at the different universes here, we're looking at US large, developed, emerging markets, and global portfolios. We see excess return of around 30 to 60 basis points in the emerging markets, where we have higher volatility and higher potential for mispricing. But in the developed markets, it's about, on average, 30 to 40 basis points. In the emerging markets, slightly more so, close to 60 basis points. It comes with some slight tracking error, about 100 basis points, 1 percentage point. So if we were to compare it apples to apples, so if cap-weighted strategy were to be selected 86% based on cap, we would see turnover, let's say in the United States, of 5.6% return, slightly higher than S&P. So what tells us that S&P actually do dampen a little bit their turnover. Well, if we're to reduce select based on fundamentals, that would further reduce the turnover and would bring better performance. So the bottom line, I don't want to argue that this for this particular approach. There are in the article we've done a few other approaches. For example, why don't we just postpone the S&P 500 performance by a year? Turnover exactly the same, but we would not do exactly compete with the rest of the market, and we would avoid part of the buy high sell low dynamic. And or we could use 5-year average market cap to select companies. All of these techniques lead to about the same outcome. And so, and the key reason for doing so is that it avoids buying high and selling low. And by the way, these are not the only techniques that could be brought. So I mentioned already that even selecting based on measures like fundamentally weighting, or let's say 5-year average cap weight would reduce turnover. There are further ways to engineer strategies with lower turnover. For example, introducing some banding or introducing a little bit of momentum filtering, where if company is on the run, you don't trade against momentum. So with all of these techniques, these transaction costs could be even further reduced. So the bottom line is passive indices are having, so they're believed to be great strategies in a sense, and they are in many respects. They are representing big chunk of the market, and they are beating the bulk of the passive managers, of the active managers. But at the same time, the idea that they can be improved is not true. That we can do slightly better by tweaking them on the margin, that basically, as I've shown to you, the index buys high, buys at high valuations, and additions generally outperform the strategy before the announcement, and then subsequently to the point of the rebalancing. But afterwards, the performance between additions and deletions significantly reverses. And today, when we're looking at the indexing world, the fees are getting cramped to fractions of basis points. So I think when we're looking at institutional market, the investors are selecting funds based on the management fee difference of a fraction of a basis point. Yet there are tens of basis points of potentially improved performance from avoiding some of these by high sell low dynamic that could be harvested, and we think it is worthwhile the attention of the marketplace. So with this, I'd love to hear more questions.
Vitali, thank you. Anyone from the audience have questions for Vitali?
So I'll go, Lisa. Vitali, great presentation as always. Very interesting research. Would love to see the white paper and go through that. The question for you is, to some extent, we face a very competitive environment with these adds and deletes. So, BlackRock, as you know, is a big indexer, and we give a lot of thought as to how to rebalance and when to rebalance. And sometimes we pre-position, sometimes we post-position. What we found recently is that quite a lot of the movements are quote unquote wrong way. That is, ads are going down and deletes are going up. And, to us, that's a reflection of intense competition among hedge funds and so on to provide liquidity. So the question for you is, has this effect, in some sense diminished in recent years? I mean, Tesla obviously was a big outlier, but, in general, do you think that the effect is going away? And what's your thought about hedge funds, participating on the other side?
Yeah, so when we're looking at the performance, obviously a big part of the a big part of the performance driver is the value effect, right? So the company, the buy high sell low dynamic by definition favors growthy companies, and disfavors or shies away from the value companies, right? So when we're looking at the performance over time, the performance has been pretty positive pre about a decade ago. Then it became flat, and it's up, and very recently it picked up again. Now, if you were to kind of overlay it over kind of the first principal component of the relative risk, which would be the value performance, what we've seen with value is value was outperforming prior to the global financial crisis, and for the last 14 years it was underperforming. So the fact that a pretty strongly value-oriented strategy did flat in the period where much of its relative risk exposure value did poorly means that alpha was positive. That alpha was a little bit smaller, was somewhat smaller than in the prior years, but it was still positive. So I think that we do see some reduction in that alpha, and that's probably a result of what you were saying, where the hedge funds are becoming smarter and smarter, and they're pre-placing and post-placing, etc. But just given the amount of assets trading, I think part of it is just big liquidity providers of trillions of dollars who are still trading on that on those amounts, and that positive alpha still looks like an opportunity.
Got it. Thank you.
Any further questions? Going once, twice.
Oh, are you going to make your slides available?
I think we forwarded the slides, so if Lisa or somebody would be willing to forward them on, sure. Yeah, they're there for grabs.
Great. Well, we love to post slides, recordings, and papers on CDAR, so it will all be up, I think, attached to today's talk. And if anybody has trouble finding that, please just let us know. So are the recording too, Vitali, were we?
Yeah. No, well,
Fabulous.
at least we've sent the consent, so that's.
Well, this was really fantastic, and I don't know. Hope we can talk more about this. We're very interested in the subject of market caps at CEDAR, and as Anant mentioned, also at BlackRock, and we're excited about your research, which is going to be impacting ours. So thank you so much for a great talk. And with that, I want to mention that we are going to be taking a little bit of a break here. Our next meeting is 3 weeks from today. Alex Braun from St. Gallen will be talking to us. So between now and then, I wish everybody a great, safe time. And thank you again for joining us.
Thank you very much.
Thanks, Vitali.